Hey everybody, Larry Berman here, and here's what's on my radar. Crazy week in markets. We've had everything from Powell in the last few weeks saying risk on, to Powell saying risk off, to better than expected inflation data, to that's not good enough, and we've got to tamp down on asset prices. It's the middle of December. Usually this time of year, I take off the last couple of weeks. I always have an eye on markets. Don't worry about that, but just a little downtime with the family and a little bit less, in terms of the production mode, so to speak. So our last show of the year on BNN and now on YouTube is our fearless forecast for the beyond. And we haven't done these in the past, and normally I kind of review what I said last time around. So this will be a first for our YouTube channel in terms of our forecast. Let's look at some of the markets and what I think about the go forward in 2023. Okay, so S&P 500. I think we're the Fed message of higher for longer, the market expectation that don't worry, the Fed will be there, they'll cut rates. They were very, very clear in my mind, and Powell was, the markets got it wrong, higher for longer. But there was that, he left the door open a crack. So, you could argue that, markets can finish, higher next year, 38.52 as we go out this week. Where are we going to be at year end? I would guess slightly under where we are now. There might be a little bit lower, a little bit higher, a little bit Santa Claus and this and that, but maybe slightly lower than where we are. If you extend this out into 23, and I would even, guess into 24 a great degree, that our path is going to be down in the first half of the year into the low end of the range, which I think something above 3,000, 3,200, 33, 34, 35. No one can know that, right? It's going to depend on earnings. It's going to depend on the data. It's going to depend on the Fed narrative and so forth. But, here first and then a bounce. Now, is this the beginning of a rip-roaring bull market for a number of years, backed by Fed easing? And here's the challenge. Where does core inflation settle? The debate is going to rage for the next few years. And I think higher for longer. I think it's going to be stickier. And that's going to be very difficult for asset prices to reinflate. Now, keep in mind, this whole thing here was free and easy money. And that's not coming back anytime soon. And I would argue the valuations here weren't supported by the multiple. So what do earnings do in the next few years? Earnings are going to come down, 23 flat, maybe some growth in 24. But where earnings are now, I would guess 2 years from now, they're not going to be materially higher after going down in 23. So some growth in 24, but how much do you want to pay for that? And I would argue that we're looking at a sideways range over the next couple of years. I know I'm a Grinch, and I apologize for it, but I think what people tune in to hear is my honest opinion, not the pom-pom Wall Street, rah-rah. I might be wrong. I hope I'm wrong. I hope it's better than that. But that's kind of what I see in my lens. What does that mean for the TSX? I think it's actually worse, because a lot of this was Shopify going from $50 to $200 back to 50. That's not coming again anytime soon in a company that makes no money. I get it, great company, disruptor, all good, but that's not coming back anytime soon. So what's going to have to push the TSX if it's going to do better are the banks and the energy stocks and the commodities. And I would argue in a recession, none of that looks good. And I get the oil story. I do. I understand the oil story quite well in terms of the supply rebalancing and everything else. So I would argue that the TSX, very similar, certainly for 2023. We'll see what happens in the recession that is a virtual certainty to oil prices. And, with that in mind, let's kind of have a look at that. So in technical analysis, purely technical, no fundamentals, in this lens, what was support becomes resistance, and what was resistance becomes support. And we've broken above that resistance, and now that should be support. So what I would argue that even in the worst case scenario in a recession, now not if it's terrible, but in the worst case, that we probably hold in the low 60s. And to me, that would be the bottom end of the range right now, with West Texas trading at 74 and change. I get the oil story. I do. I get the narrative. I understand. We're not, no CapEx is going. We're running out of the stuff. What I really believe is that peak demand for oil comes way sooner than the bulls would have us believe. Again, my view on the world, not necessarily right, but my view, which means to me that the war spike here are the highs and we don't go higher. We'll see what the next few years brings, but I think 2023 is going to be a new base building here. And, maybe we see 100 at the upside on a rally, depending on China reopening and some other things that certainly can drive oil prices to the upside. I did see a headline pass on Friday that the Strategic Oil Reserve will be rebuilt starting in 2023. I didn't dig into the story yet, but I did see the headline. Obviously very supportive. Didn't really help the markets much today. When that headline hit, I think we got a small uptick. But anyways, we'll see. Call it 60 at the low end, 100 at the high end. But I expect the first part of the year, as the recession gets debated, that we're in the lower end of this range. And then, if they buy the dip, which they should be, to replenish the strategic reserve, then those lows would hold. And I would argue it's supportive, doesn't mean, they'd be absolutely fools to replenish above $100. Anyways, my view on the world. Interest rates, US 10-year, the benchmark of the world. Looking out a couple of years here, we probably have seen the high. Okay, now on a supply basis, we could easily argue that yields need to go higher. My contention is that the world can't handle it, and the recession demand for duration would limit that. So we'll see how that plays out in 2023. I'm extending the forecast here a little bit more. I don't think we can sustain, with sticky inflation, I don't think 10s can be sustained, even if it's a bad recession, much below 2.5. We'll see, but I think inflation settles closer to 2.5 to 3, not 2 or below. And at some point in 2023, the Fed will cop to that and say we're raising our target. That'll be the debate for 2023. So that's our trading range. It's pretty broad. If we see supply forces pushing us back above 4, I think that's a buy signal. If we get south of 3, I don't think you want much exposure to long bonds. Maybe it spikes to 250 if the recession is really bad in 2023. And finally, gold. The gold bugs out there. We should be able to maintain a higher base here in gold, given the more persistent inflation. But gold struggles when real interest rates turn positive. And that could see a move in gold, not back to these levels at all, but maybe we see 14 or 1500, maybe. I like to think gold will be a persistent hedge as cryptocurrencies and all those other, say, nonsensical speculation assets kind of go out of favor a little bit. And I think that's the next few years. So I think gold, some shine comes back to gold, but the much higher prices are going to be a challenge here. It just hasn't been something that broad-based investors have been willing to do, even when all the risk is on and everything makes sense for gold to go. Just doesn't seem that way. So, projecting out a couple years here, I think trading range, you buy the dips, but really you got to sell the rips as well. Anyways, have a great week, everyone. Have a great holiday. Last one for the year. Hope everyone has a healthy and happy 2023. There are no bull and bear picks of the week here. They are on vacation as well.